It's 5 o'clock in London, it's midday in New York, 12 a.m. in Hong Kong, midnight, 2 a.m. in Sydney, 9 a.m. in San Francisco, and 9:30 at night in Mumbai. Greetings, good morning, good afternoon, good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO-VID livestream, Series 30, episode number 6. That, well, at least it's pretty easy math today, means we're on a beautiful GAN episode number 180 starts here. Let's start with a couple of mentions, and then we'll get into the exciting new format for today. Gosh, ASX, what not to say? Actually, we're going to discuss this. I mean, the latest worry for ASX is that the regulator may be planning a great cleaving, splitting the primary and secondary markets business from its clearing and settlement monopoly. Well, winter is coming, it seems, if you're within the ASX, but probably not before time. On the other hand, let's also look at a really, really happy piece of news. The Hong Kong Exchange's 25th anniversary. Great to see the Gong Show, or rather, to be precise, the Gong Tour. We're going to have more about that as it comes along. Ongoing at the moment, there is the Hong Kong Exchange's Gong, that's their version of the bell in Southeast Asia, is being driven on a van, on a lorry, around the entire SAR of Hong Kong in order to meet the people. So far, more than 100 Hong Kong Exchange's staff have been participating, led by Chief Executive Connie Chan, and indeed, it's absolutely superb. The Hong Kong SAR may not be that huge, but it's big enough. And with a population of 7.5 million people, this is just the most marvelous opportunity to mark the 25th anniversary of Hong Kong's unified stock exchange and trumpet the incredible benefits of owning shares, including, it has to be said, Hong Kong exchanges, which were listed at 388 Hong Kong dollars with the ticker sign 388. 25 years ago this month. And a fun fact for you there, Hong Kong Exchange's shareholders have seen, if you were there at issue, $3.88 Hong Kong to $419.60 at the close on Monday, or at least a couple of days ago. Quite incredible. It's certainly hovering around 400 Hong Kong dollars as I speak. Now, ladies and gentlemen, I said we were going to have a different format this week, and the great news is you're going to get less of me, because we're introducing a panel format for this week. Conversations with my good friend Mark Beddis led us into the idea that why don't we try our own, well, call it a, if you want, all in for capital markets and financial market structure. And we have invited to this first show the opportunity for Ann Berg, our commodities doyen, and Peter Randall. Let's give them a brief introduction, each of them. Mark Beddis retired from CBOT this year, having been a co-founder of VIDS. He's a long pedigree at the nexus of tech, product development, and markets, and was indeed a guest on IPO-VID, just within the course of the last month and a half. Ann Berg, her appearance on IPO-VID dates back to last appearance dates back to a year or so ago, and is a leading expert in commodities, commodity futures, and food security issues worldwide. She's a former grain exporter, futures trader, and CBOT director. And last but by no means least, Peter Randall, who was on this show actually several years ago. Peter, it's been quite a while, hasn't it? Peter Randall is a former stock analyst who was co-founder and CEO of Chi-X, which revolutionized the London stock trading and market, in fact, the European stock trading marketplaces. And like our panel, is a revolutionary in markets who went on to be president of Settle, which was a breakthrough DLT CSD technology. So, greetings, everybody. I'm going to ask you to tell us where you in the world you are today as we go along, but let's get straight into the conversation. And hopefully, you can partially disintermediate me. I'll jump in when I get something to say. Let's jump to Australia. I mean, ASX. We've had a rebrand, we've had all manner of fear, doom, and goodness knows whatever, and that's in the last 2 weeks. The government coming in, asking regulators, saying we're going to give an unparalleled investigation of what's going on. And as part of this mega report, stories are now that the ASX might lose their clearing assets with what I've been calling Exchange Invest, the Great Cleaving. Peter, I'm going to let you start the discussion. What do you reckon to that, and where in the world are you today?
I'm in London. So thank you very much indeed, Patrick. Very kind and generous introduction. It seems to me that there are some sort of basic facts that we probably need to get out onto the table quickly. First fact, which I think is very important, I think I read it in Chanticleer in the Australian Financial Review, which is that the rebranding of the ASX, which was announced last week, is essential because they've got the sky rights, the naming rights to the brand new building in Martin Place that they're going into, which will have a great big illuminated logo of the Australian Stock Exchange on the outside. And evidently, a branding expert said that you couldn't see the old one. It wasn't particularly clear, but the new one, don't worry, will shine out over Sydney and across the land to tell people that the ASX or 2000. So that's the first point. The second point, which I think is incredibly important, is that I understand, and certainly from lots of work I've seen, that Australia is the fourth most expensive market in the world to trade in. That's a combination, obviously, of its clearing and settlement costs, which is a combination of fees that are charged to the dealers, but it's the fourth most expensive, which is pretty unsustainable, I would say. Third point, which again is incredibly important, is the extraordinarily large pool of assets that actually exist in Australia. Superannuation has been going now for 25 years or so, maybe even a little longer than that, and is now, I believe, in the region of $2.5 trillion US. So that puts it on par with sort of quite a large number of sovereign wealth. You've got this large pool of assets, you've got a relatively small group of people, 30 million, I believe, and we've got a monopoly provider which has been, as they say in the funding community, the sun has been shining and they've been making it. So change comes, probably time.
Mark.
Yeah, I think that's interesting. Yeah, this point about the Australian market being seriously, punching above its weight, if you like, in terms of population size, in terms of its superannuation funds and all of that. It's a very important market. I think the difficulties that ASX is having, it's very sad in a way, actually, because if you go back to the sort of 80s and 90s, they were absolute pioneers in both equities and in the derivatives markets. With the derivatives was, then you had the Sydney Futures Exchange as well, and I wonder if the decline in its sort of reputation does go back to the merger there that happened in the early 2000s. I'm not sure, but certainly maybe this is a trigger point where they change direction and they address these issues. I'm not sure. I do think the idea of them splitting the exchange from the clearing is an interesting one. If you look at the US market, that clearing is separate from all the exchanges. Almost has to be, right, with the competitive structure that you have there. And I have to say that that's evolved very well. So maybe there's a model there for them to look at. It certainly would be fascinating if a separate clearing operation could be set up, because what that does for the potential for competition between ASX and the other exchanges would be, I think, it would inevitably create new opportunities and growth, because that's what's happened in the US. A lot of people criticize the US market with always competing exchanges and the regulations around them. So maybe there's lessons that could be learned there in terms of how you regulate under that structure. But the idea of a separate clearinghouse, I think it's kind of attractive. And I'd be interested to know, the alternative model would be separate clearing houses, which I think it'd be interesting to know what Anne feels about that with her experience, because I've always wondered if a competing clearing structure can be made to work. I think one of the theories is that one big clearinghouse with all the assets consolidated into that single entity is optimal for risk management purposes. But with the interconnections between clearinghouses, some of those problems can be addressed. So let's think forward to that world where there is a separate clearing structure in Australia. Could it turn into competing clearinghouses? I think unlikely, but would that model work?
Anne, what do you reckon?
This is a great big question. When I first started and when I got out to board of directors at the CBOT, we had a separate clearing corporation, which was the Board of Trade Clearing Corp. And as a matter of fact, that's enjoying its centenary this year. It was formed in 1925. And before that, you had some sort of bilateral clearing that went on. I guess I'm a little bit slightly too young to remember that back a century ago. But that was the first clearing corporation that was formed as far as, well, I'm sure it was because it was part of the US experiment. So that clearing was really held apart from the exchange. And the model I felt worked really, really well. Then the FCMs wanted what was called common clearing. This is before the merger with the CME. So that they wanted to be able to pick and choose their clearing house into which to put their funds and capital and so on. But the only problem with that in the derivatives markets is that derivatives contracts are proprietary instruments. So that excuse me, if you ever had a problem in a contract, you might have for example, the Board of Trade saying, well, we're going to have liquidation only in this contract because there's a market manipulation going on. And then some other clearing corporation could be basically open for business. So it didn't make much sense to have this so-called common clearing. So to get back to the point is that independent clearing worked, I thought, extremely well, but it was in a derivative setting as opposed to an equities setting, which of course have, these are not contracts, but shares of equity ownership or bonds and credit relationships and so on. So it's a completely different, not completely different, but it's certainly different from a derivatives marketplace.
And it's interesting, isn't it? I mean, that's great color because you remind us of, the European brokers tried to do something similar with cleaving apart clearing during the course of sort of the last decade. And it's also fascinating, though, because the ASX could blaze a trail for the first time in 30 years. And I'm with you, Mark. The Australian Stock Exchange of the 1980s was an incredible thing. Into the 90s, first to demutualize as a going member entity, first to list on its own exchange as a going member, previously member entity that had demutualized, went electronic memorably on Monday, October the 19th, 1987, which 9 months earlier in a planning meeting had seemed like a perfectly innocuous Q4 date. And they were a trailblazer for so long. But what interests me actually is that if they scythe all of the clearing and settlement assets off, we would have a unique infrastructure here because we would have the world's only independent clearinghouse for derivatives, clearinghouse for equities, and CSD settlement entity. Now that would really make for something very, very different, wouldn't it, Peter?
Yeah, I think difference and change is certainly coming down the pike. A couple of points that I'd just like to make that, you talked earlier, Mark certainly spoke about, institutions which have clearing as part of them, institutions which don't have clearing and settlement as part of them. And, your introduction of the Hong Kong Stock Exchange, of course, the Hong Kong Stock Exchange has clearing and settlement in it. And, maybe you could argue that when I bought my stock at 388 back in 1988, that I was very, very lucky because, there was a great business model. So there are good economic reasons to do these things. But there's one really important thing which I don't think we've sort of kind of teased out yet, which is that the nature of the market has dramatically changed. So let's just focus, if you will, for a minute, and I think that we do that largely in Australia. There's a lot more retail investment. In fact, I would argue the largest part of retail investment is actually it takes place these days between online brokers who've actually got cash or stock on the books in the records, available for delivery almost immediately. So you can then begin to sort of ask the question, to what extent are all these constructs of clearing, where a buyer, where a house becomes a buyer to every seller and a seller to every buyer, if those assets are already effectively held in a trusted financial institution like a bank, then why are we even paying for this service? There are a lot of questions here.
Yes, it could potentially blow up a lot of the clearing model from start to finish, couldn't it, Anne?
Well, let me just bring up an old point again. I know I'm going backwards and you're trying to go forwards, but during the fruitsy soybean squeeze, I think that was in '89, what happened was that the clearing corporation decided to raise margins, but the exchange itself that was in control, they were the ones who had the licensed contracts. They voted to have liquidation only of the contracts. So you have the clearing corporation taking one stance, and they're not necessarily contradictory. In fact, they worked together, but you had the margins, the money angle from the clearing corporation, and then you had the decree of it's going to be liquidation only for the contract itself. So, of course, the Board of Trade suffered 10 years of lawsuits after this happened. So because of the farmers, naturally, they like beans in the teens. It was $13 beans or $14, and the whole balloon just completely deflated once. And of course, the soybeans were trading at multiple dollars above the cash market, so that the futures price was $13, where the farm price was only $9 or something. And but that farm price also went down when liquidation started. So I don't know if I'm bringing up something relevant here, but they had different functions that you have to think about way back then.
That's fascinating, actually, the convocation of risk and so on. I mean, Mark, there are so many variables in here, and it does start to raise the question of, if you have all the stock in one place, just how much does it really cost to have a CCP and a CSD structure ongoing?
Yeah, I mean, what this raises, once again, in my mind, is what the role of technology in all of this. If you describe the things that Ann and Peter have been talking about there, different structures, different players, their role sort of being evolving and changing. Like you say, the banks holding most of the stock, or clearinghouses and exchanges having different risk management policies. To what extent is technology potentially going to play a role in all of this? Because in days gone by, when most stuff was being done manually, you had these when the crises emerged. One of the biggest problems was the sheer management of the paperwork and management of who's got what and how we're going to make these decisions. And you'd have committees and subcommittees meeting in crisis mode to figure it all out. I'm no expert on the post-trade end of things, so I'm curious to know what Ann and Peter think of how technology has changed in such a way that some of these problems that used to exist could actually be addressed because of the ability to track information, process information extremely quickly, and have good quality connectivity between the various players. I mean, do you have any maybe bigger thoughts on the role of technology?
I'll defer to Peter on this.
I was happy to let Anne speak first, but yeah, I mean, I think there is something which is just pretty obvious, really, which is that back in the day, most of the technology that we have all grown up with was batch technology. You had to wait until some point in the evening, at which point all the stars would align and the machine would whir and the answers would come out. And that's because back in the day, memory was incredibly expensive. So you did everything you possibly could to sort of minimize the use of expensive resources. Today, given the sort of major changes in technology, that constraint has gone away. So there's a lot more data that moves around, for sure, but there's also a lot more data about the data that moves around, as to where assets are, what sort of shape they're in, and all the rest of it. So I do think there's quite quite a powerful argument to say that what tends to happen at these institutions, and you certainly saw it at the London Stock Exchange, you've seen it in many places, is that, and I would contend that this is hugely germane to this particular topic. 30 years ago, they did put in the right technology. They did something really revolutionary. And for the last 30 years, they've done the same thing every year, which was sort of take the money out the back end. Very, very few changes, very, very little renewal, very little development, if you will, of a bigger and better model. So it seems to me that that's what happens. The market eventually catches up with you, and that's what's happening here. The market has caught up with people.
But why have clearing projects always been the graveyard of so many organizations? I mean, this situation in Australia is not the first time it's happened, has it? You have a big, I can think of a few cases, in the past of projects I've been associated with clearing, and the ones that were always the hardest to get done were clearing projects, which is kind of ironic in a way, because it seems, on the face of it, it should be a straightforward process, and yet we see these disasters happening. Do you have a theory, Peter, on why clearing is such a difficult?
It isn't actually all that difficult, because if you go back to the start, effectively, of Chi-X, 2006-07, in addition to setting up a platform to do the trading, we also set up a multilateral clearing facility. And that multilateral clearing facility went on and has become now the largest clearing facility in Europe. It's perfectly possible to rest, W-R-E-S-T, the liquidity from an incumbent. And the way you do it is by offering superior service, and guess what? Lower prices.
Right.
But you're right. I mean, also, it's a great point. I mean, Mark also makes, and you make, Peter, which is, this has been an incredible graveyard. I mean, all the way back to Taurus, which was really the moment where the London... Yes, I know we're all grinning, because, I mean, that was just such a fiasco at the London Stock Exchange. And really, the London Stock Exchange never recovered in many ways. It is amazing how many of these things go wrong. And obviously, back to, ASX, our troubled love child of the week. As you say, they're busy trying to get the right branding for the naming rights for the Swish waterfront offices that they've now bought in the most expensive development, I think, in the history of the CBD in Sydney. But they've already lost, 250 million Australian dollars, give or take, on the DAH solution, which went absolutely nowhere.
I could add maybe something small here, when I also did consulting for the UN and for the USAID, another organization. So in particular, when I was in Vietnam, there was a bank who wanted to do the settlement for the coffee exchange, which was not quite getting off the ground at that point. And the exchange did not want to take the risk of default. So clearing simply... There was no such thing as clearing, because nobody would take that risk of default. The bank wanted a risk-free settlement fee, just a cash cow, basically. And the exchange, when they started thinking about, well, what does that mean? Well, it meant every member, of course, was going to be on the hook for some sort of default. So, and you saw the same thing when I was talking about common clearing before. That, in fact, I think the debate still goes on as to who's going to have the most skin in the game when there's a default scenario. Is it going to be the members, or is it going to be the exchange? And of course, there's all these elaborate structures and waterfall structures to help take care of this default event. But yet, all of the parties are all interconnected with one another, so there's no way that a default, or one large default, wouldn't affect all of them in a string-like, a network-like basis. So I don't know if that answers the question that you're asking, why there's such a difficulty with clearing, but I think it's just all about money.
Can I sort of bring it into a slightly different focus at this point, just to mix things up a bit. I mean, certainly I can remember, I'm sure Mark can, Patrick, I'm not sure about you, Anne, but we'll remember when in 1987, the Hong Kong Exchange was out. It was out for a total of about 8 days. And the futures market was out for nearly 2 weeks. It was out, and ultimately what happened was that there was capacity within the central banking system to make sure that there were enough dollars available to affect banks' balance sheet positions and to fund those balance sheet positions whilst the exchange got themselves sorted out. So let's run forward now to Lehman, where we know that the Lehman crisis and the unwinding through LCH did put an enormous amount of pressure on global central banks. And had it not been for the swap lines that had been negotiated between those major G7 economy and the Federal Reserve, they themselves would not have had enough dollars to meet the obligations that their members were trying to borrow from. Of course, they borrowed at a cost. We're not saying it was risk-free. But here's the real big question. In the next financial crisis, and guess what? One's coming. I can say that with absolute certainty. In the next financial crisis, given the particular situation that seems to be going on at the moment between Jay Powell and the White House, I'm not sure that the capacity of the Federal Reserve to negotiate those swap lines and provide that sort of dollar liquidity is necessarily going to be there. That causes a real problem for global trading. More importantly, I suspect that what's actually happening is happening now in probably more ways than we can count. But the same sorts of things that happened in the United Kingdom from the 1930s onwards, culminating in 1947 with the first big dollar crisis. I suspect that sort of position is going to be happening now in the United States increasingly frequently. And my question is, to what extent can we rely upon the Fed to produce those swap lines to keep global liquidity alive? I'm not so sure that I understand what the answer to that is.
Well, the role of the giant central government in all of this has always been, it's happened several times now, where the authorities have said, okay, we stand behind whatever risk is there. We stand behind it. So we had, for example, I thought the way that the Fed handled the crisis, the most, in 2020, when the COVID crisis, if you like, was interesting in the way that they used different instruments to support the market. The ETF fixed income market became the avenue for them to hold things together. And the mere statement of a central government saying, this is what we're going to do, we're going to support this, sometimes doesn't it have a psychological impact? I always think back to the time of the BP privatization in the 80s, and I think that happened around the same time as the crash. So suddenly, everybody had bought all this BP stock, and then the market collapsed, and all the retail investors were in a panic. And the government said, "Well, basically, we will underpin that. You can sell BP to us at any time at this price." And it immediately had the impact of saying, "Okay, well, at least I'm basically everyone had an option on it," and it stabilized things. So, the role of psychology is maybe more important than anything else, more important than the actual liquidity that's available to the central government to support something. So isn't that really what we're talking about? And isn't that the essence of all financial markets? At the end of the day, it's confidence and belief that supports it, not actual assets.
Well, and actually, if I remember correctly, wasn't the BP situation quite hilarious? Because the underwriters tried to get them to pull the offer. And Mrs. Thatcher herself memorably said, well, no, that's what you get paid a fee for, is to take the risk. And she basically loaded them with a huge number of shares that it took them quite some time to get rid of subsequently. I seem to recall there was something like that. Peter, you might remember better, but Mark's question is better.
It was BP or British Gas.
Could have been British Gas, actually. I think you're right.
It was British Gas.
Oh,
but that's,
okay, right.
It could be either. It could be either. But no, I think what my point is, and against that sort of obvious COVID intervention, there was no leverage in COVID. In financial markets, particularly with some of the more sophisticated exotic derivatives, there is so much leverage. In fact, still, as we know today, there's leverage on leverage. That type of leverage can only really be met by very deep-pocketed central banks. And my worry is, to what extent will those swap lines between the bank where the crisis occurs and everybody else in the rest of the world, that's always in the past been underpinned and underwritten, if you will, for a fee, a good fee, by the Federal Reserve. Is that going to continue? I suspect the answer is yes, I think it probably will continue, but with certainly, a lower degree of certainty, i.e. a higher risk it might not.
Fascinating altogether. How do you feel about the leverage question, Anne?
Oh, leverage. Isn't that the thing that's caused all of these financial crises to begin with? So, the 100 on 100, I think that's a good point. There's been multiple, I don't know if you should call them exchanges. There were about 10 years ago, I think, there was this currency trading platform that they were allowing, I think, 100 to 1 leverage in the Swiss franc pair against either the dollar or the British pound, and that completely blew up in their face. But so I don't know. I think the idea of market sentiment is a very good one, because that's what you see obviously on a day-to-day basis. Maybe it comes back to the mean after a while, but look what happened to the markets yesterday with in the oil, where the spike up, and then it was the whole complex just deflated. So,
well, isn't that an interesting trend, Anne, that we've been seeing recently? That it seems that over the weekend everybody gets themselves into a froth, and notwithstanding the fact that Peter is indubitably right that the next financial crisis is coming. But I mean, what we've seen for the last 2 months is everything that goes wrong is that's it. It's the crash. It's the end of the world. And yesterday you saw the incredible thing. I mean, Murban futures, which are actually off. I mean, Murban oil is loaded essentially on the cusp of the Straits of Hormuz, and yet it rocketed up, but it's nowhere near, and then went down in price, was down on the day on ICE futures Abu Dhabi, and we're nowhere near the $115 that all the Cassandra Inc. was confidently predicting on Saturday.
Well, tell me about it. Yeah, no, and in fact, Brent.
A lot of market makers made a lot of money.
Carry on, Anne.
No, I was just going to say, just that Brent went below 70, I guess, this morning. But when I worked for the UN in Rome, which was the Food and Agricultural Organization, all of the analysts had on their forecasting $135 oil. That's when oil, I think, was about just $80 or $90. This is back in 2011, 12. And I would say, well, how do you get that? How do you come up to 135? No, it's just a straight line projection. So I thought, well, gee, I could do that, project price from today, yes, but without, they seemingly didn't put in any types of other variables. And it's always the black swan event that's going to determine commodity prices in any case. It's a drought, it's a war, it's something that you didn't anticipate. This business of the nuclear strikes, I think, was highly anticipated.
Yeah, well, I mean, that was highly anticipated. And I think also it's quite incredible because we're certainly seeing a lot of shibboleths broken during the course of this year. I mean, Iran looked like an impossible to defeat regional power only 18 months ago. And now it looks as if it's uninvadable. It's not going to be conquered, but it's nonetheless a shadow of its previous self. And that's certainly been one of many things that have been turned upside down. And indeed brings us to maybe the topic of tariffs, because, look at this world of tariffs. First of all, does anybody remember that just 6 weeks ago, tariffs were going to end the world?
Oh, yeah.
It's quite funny, really. I mean, I sat on FinTech TV, whatever it was, 5 or 6 weeks ago, and looked incredibly mature because Jim Cramer was busy telling all the CNBC people that it was the end of the world. That was it. It was the greatest crash ever. And I was saying, well, channeling presidents past, the only thing we have to fear is fear itself. And I mean, but the whole world, I mean, it's incredible that in this year, Iran has essentially been wiped out as a regional power for the time being, and its proxies are all in very great difficulties, if not effectively wiped out. The tariff picture in the world has been completely reshaded to the point where the British Prime Minister is ringing car manufacturers and saying, gosh, look, I got you a great deal. And the great deal is that they're paying 10% more in tariffs than they were previously, and everybody's rejoicing. I don't know, what does anybody else have to think about that?
There was a very interesting article by, Clive Crook. I think he used to be with The Economist and he's now with Bloomberg, a couple of weeks ago. And he was basically postulating that actually there's a very real possibility that the world will accept that tariffs is the new norm. And that, for example, in the US, the bigger producers, bigger manufacturers who are exposed to tariffs or involved in tariffs will learn to live with them and actually welcome them, because of in the old days it was just pure protectionism. That's what it is. And he felt that it's very, very possible that the US industry, the entire commercial sector will accept tariffs as the new norm and learn to live with them, as will the rest of the world, which, I'm sure most, the accepted opinion is that's a bad thing. And, it's not good for the economy. It's not good for growth, but it could well be the reality. So that's a kind of gloomy outlook that he was putting forward. But I think it's actually realistic, maybe.
Well, I think, though, that the world, the rest of the world, besides the United States, started really pumping up their tariffs on imported goods to protect, it's what emerging markets do. And I think, India, Vietnam would be good examples of putting on tariffs. And of course, they still have the one industry they cannot crack whatsoever is agriculture. Every country, and, for good reason, wants to have food security. So they protect their farmers, and there's huge tariffs on Indian corn, I think it is. So the tariffs, though, on the sorts of consumer industries were raised in a lot of the emerging markets while the United States was not doing anything. But the United States remained still the biggest economy. So, in fact, grew so much more than Europe over the past 15 years. So I don't think it was looked upon. It wasn't until Trump came into power to say that, okay, well, I love tariffs and we're going to put tariffs on everything. And at first, I think that I saw it as a pretty decent negotiation. No, first of all, I thought this is stupid. The second thing was, okay, it's a negotiating tool, which I understand. And I think it's turned out to be more of a negotiating tool than anything. But there are some tariffs where I just don't see that we're going to achieve, we being in the United States, are going to achieve the results that the current administration is looking for. You're going to create high-priced products, and to think that you're going to sell high-priced automobiles to India when the average Indian makes $3,000 to $4,000 per year, that's just not going to happen. So the distribution of these high price goods, they're going to be a little higher price than before, is going to be within the United States. So we haven't seen all of the fallout from this, and I'm still kind of reserving my opinion on tariffs until I see. I think you need a good year to look at this. That's just my opinion as a free trader.
New Zealand doesn't have tariffs, doesn't support its farmers in any way, but that's,
right.
It's tiny. It's tiny. I agree. But the share of the US share of world trade now has dropped, I think, to 25% from way above 50%. I don't think it's ever going to go back to that sort of high levels of, 45, 55%. I think the model is much more likely to be.
You're talking GDP or trade?
Sorry?
Okay.
Trade.
I'm sorry. Were you talking, Peter? You're talking trade. It's also the GDP was over, I think, 45% at the end of the World War II, and is down to what, 25 today,
now.
As these other countries.
I think, again, and it's instructive to read it, there's a very, very, very good book by Barry Eichengreen on central banks and how they manage transitions between
He's very good.
The dominant currency and emerging currencies. Just go back to what happened in the 1930s in the United Kingdom. There was empire preference. Empire preference was effectively a tariff wall that kept out American manufacturers. It failed. It failed spectacularly in the sense that Her Majesty's government had to go, or His Majesty's government had to go cap in hand to the Americans in 1941 for Lend-Lease to be able to prosecute the war effort. However, the history repeating itself argument, I think, is quite important. The more worrying one, though, for me, and I agree with everything you've said, Anne, certainly about agriculture. But the more worrying one for me is, at what point does somebody think, well, we can charge tariffs on automobiles, or we can charge tariffs on electronics. Why don't we charge a tariff on the dollar? Why don't we say that if you are buying dollars for investment purposes, you're going to get you're going to have to pay a tax. There's a Tobin tax for foreigners that are going to have to be used to support US Treasury revenue raising. Now that, which is dead easy to collect, so it's very cheap, that is a real, I see as a very, very real black cloud on the horizon.
Right. I call it another trade distorting ad hoc measure, I guess you would call it. That is a huge concern. And I don't know how you feel about this stablecoin issue, but everyone puts, crypto in the same bucket. So, I mean, this is about stablecoins are about as far away from Bitcoin as you can get. And I think under the sense, the Treasury Secretary thinking it is that having stable coins will ensure that you have a huge customer base for U.S. Treasuries. That's how he's kind of explained it, to make it easier for.
Yes and no. I mean, I think it just goes back to that same point that we made earlier about liquidity. When there is a crisis in the stablecoin market, guess what? There will be one. When there is one, and they break the buck effectively, they don't look like a money market fund because they don't ultimately have the backing of the Federal Reserve. When there is a crisis and everybody wants to sell all at once, then what is going to have to happen? Well, what is going to have to happen effectively is that the stablecoin providers will have to start liquidating their treasury holdings. When they start to liquidate those treasury holdings, what happens to the price of treasuries? Effectively, they go down. So what happens to yields? They go up. That's not a very clever set of circumstances. I think it's about 235, 250 billion at the moment in stable coins. It's big. It's not anything that the Federal Reserve couldn't sort of deal with, after a good lunch on Thursday. But it seems to me that
it's like a leaky pipe.
Yes, indeed. There is a problem with it.
Yeah, and I mean that leaking pipe could become colossal. Go ahead, Dan.
Yeah. No,
Go
I
ahead,
just I think that there's all of this. There's so much hype in all of these things that I'm used to sound money. Not that we've had that in my lifetime, really, but well, actually, we did because of the gold standard, if you want to call it that way. But then the balance of payments, of course, is what forced Nixon to recall the dollar, and it's $35 an ounce peg. So there seems to be so much, and we go back to almost market sentiment that these things are great. Well, they're great for the issuers because they make fees.
Yeah,
and it's just it's like a cornucopia of money falling into their laps because they've got this brand new shiny object called stablecoin, and they issue it to mostly I think it's young people who I don't think have the same concept of money and currency that I grew up with, and I'm sure the rest of my colleagues here would share that sentiment. Money's become trivialized in my mind. It's just you don't even know what it is.
The youth of today, they don't even know what Herstatt is. There you go.
That's right. 1974.
Absolutely. But Herstatt in 1974, and famously, of course, what was it? Kreditanstalt in about 1929, 1930, wasn't that? That was seen to be a harbinger of terrible times.
That was the end of the crown, right?
Yeah.
Yeah.
That's right. Yeah.
The Austrian crown.
But it's interesting because actually you think about that. I mean, one thing that intrigues me, I got to say, just rounding this segment up, is that everybody talks about the death of the dollar. Yet since I have had any sort of vague consciousness, even as a child in the 1970s, people have been saying, well, that's it. That's the end of the US dollar. And they continue to say it today. Now, no doubt someone sooner or later is going to be right. But having said the same thing for essentially 50 years, I'm not sure that necessarily gives us a lot of faith in, well, the sort of people who make predictions, presumably.
Well, it was, I mean, especially over the last few years, I mean, prior to this year, it seemed every item of news was good for the US dollar. Like, bad news was good for the US dollar because it's a safe haven. Good news was good for the US dollar because the economy was going to thrive. I think that connection's broken a little bit this year, but not by a lot. It's still up there, still stronger. I track it against the Canadian dollar because that's where I live, and it's higher now than over the last 20-year average. One other point, coming back to Peter's point about the tax, the quasi-Tobin tax on the US dollar. One nice thing about that I think we've learned this year with all the tariff stuff is that when an announcement is made about a tariff or a tax like that or an idea like that, and it gets public, and there's a sentiment that it really could happen, the market reacts, and the market tells you how good an idea that was. And I think we should look to the market and trust it to a large extent, because the signaling is there. It's very effective.
Well, to your point, I mean, when everyone was talking about the BRICS currency, I thought, well, what are they talking about? I mean, how do you possibly have a central bank for current? They're all, I call them the basket of the deplorables, really, because there's not a good other than the Chinese currency, whether it's the Russian ruble or the Brazilian real, the Indian rupee, they're all depreciated to lows, all-time lows, and you can't. How do you put faith in that as a currency? And even Russia complains about the fact they have too many Indian rupees on their books because they sell oil to India, and Prime Minister Modi is all very happy to accept that and pay Russia in their rupees, and then the Russians can't get rid of them. So going back to the strength of the dollar is that there's just nothing for all the hype that the BRICS have gotten, the BRICS currency has gotten. Where is it? It doesn't exist. It just doesn't exist.
Wow.
Just remind you, Rick, of a famous economist that we probably all remember, which was that markets can remain irrational longer than they can remain liquid. So for your 50-year prognostication, it doesn't mean you're wrong.
No, probably so. But I think a lot of people have said, that's it, it's all over. Now it's something different, which is very different to saying that could be the peak, this could be the peak of dollar power, whatever, which I think is well, anyway, I mean, it's a great point. So let's look. I mean, we've just got 10 minutes to go, and I think it does deserve some mention. You mentioned having your shares at 388. We salute you, O guru of buying stock exchange stocks, Peter. But I mean, two of you on this panel, Mark and Peter, you've had lengthy spells in Hong Kong. Anne and I have just had the joyous benefit of tripping in and out. I was there just last month. And Hong Kong exchanges, I mean, 25 quite remarkable years. It's interesting because it sort of flouts lots of rules. It's actually a legislated state monopoly, which makes it very unique compared to everybody else who's been heading towards stock competition. But it's quite an incredibly changed enterprise from the Stock Exchange of Hong Kong, the Hong Kong Futures Exchange, and the Clearing and Settlement Utility that were all shunted together in the early days of 2000 to then list at the end of June, or was it the end of May? I think actually the listing took place in 2000 AD. Gentlemen, which one of you wants to go first from your Hong Kong experience?
Mark.
Okay. Well, yeah, it's been amazing, and it kind of annoys me that they've been so successful because I'm not a monopolist. But there you go. Sometimes authoritarianism kind of works over time, but to my mind, this is an interesting development. You know, we were just talking about the sort of the split of the global market, the US dollar and non-US dollar. You know, Hong Kong, despite all the troubles over the last few years, still is a window to the Western world for you know, for assets in that region, China specifically, of course. And so, you know, as you pointed out, Patrick, the opportunities arising out of that, you can't ignore them, and it's going to be very interesting to see, you know, how much of these Chinese companies that, you know, obviously are now going to focus on Hong Kong as their primary listing for foreign investment. So yeah, you have to be optimistic for their chances. The only thing from my recent experience with them is I feel that the regulation there has become way more onerous than it used to be. Back in the 90s, funnily enough, it was really the SFC, the Securities and Futures Commission, that drove innovation in Hong Kong, and it was the exchange that was holding it back. And now, I think the role that's been reversed. So, I mean, I don't want to get into specifics, but there've been some instances where I think the regulation in Hong Kong has been holding back innovation, and that's the only worry that I have, that you know, will it be too easy to just take those listings and just you know, trade away, or are they missing even greater opportunities through the sort of hostile environment that exists there for innovative ideas? That's my subjective take on it.
Let's not forget, it's very important to make sure that we focus very much on this. Let's not forget that Shanghai is much bigger than Hong Kong. Shanghai is the place, as far as investors in that particular part of the world, 1.2, 1.3 billion people, are focused. Hong Kong is big, but you know, it's familiar, but it's not half as important in real terms as the Shanghai exchange. I think that's the first point. Second point I'd make is that my view of Hong Kong, really, since going there for the first time in, I think, 1985, so quite a while, 40 odd years, is that Hong Kong always was a collection of building sites connected by a series of roadworks. That really hasn't changed. Yes, it's very, very dynamic. Yes, it's very, very exciting. But what I would say, really about Asia? Because I've been in Asia long enough, or I'd spent enough time in Asia to know I know nothing about Asia.
No, that's a very, very interesting pointer. But what about, okay, so what about the connect angle for Hong Kong? Because it seems to me, I hear what you're saying. I mean, Shanghai is basically a much, much larger market already, but it's heavily domestic and it's not foreigner friendly. Whereas Hong Kong is selling this, we're your gateway to China play. And I would have thought that surely has a remarkable propensity to succeed, because people are more likely to want to put their money into Hong Kong. Possibly in favor, I mean, that may be one thing in favor of the SFC's greater regulation, and I hear you, Mark. How does that work? I mean, does that play, does the gateway to China thing work over the long term, or does that simply become disintermediated because sooner or later China will liberalize?
It's, I mean, in theory, all of that is true. That there is, there's demand for investment in Chinese assets, and the ability to do that in a, using Hong Kong dollars effectively, is appealing to foreign investors. But I guess it's just how much demand is there for that ultimately? I mean, outside of China. So, you've got this hostility towards Chinese investment in the US that's apparent. You see it in the news daily. That's the biggest source of foreign investment. Is there enough outside of the US to counter that? It's an unknown. If there is, I think the thesis that Hong Kong will thrive because of that is correct. So I wouldn't want to bet against it.
Peter, do you have anything to add?
Not really. No, it's
okay.
It's a very, very difficult topic. I would agree with Mark. We don't want to bet against it necessarily, but I would just urge people to believe that it's Shanghai that counts, not Hong Kong.
No, I think that's a very, very relevant place and it's a point. And certainly it's quite incredible to go to even a city like Shenzhen, which is so close to Hong Kong, and see what an incredibly marvelous collection of built environment you have, which is not the building sites and roadworks that you mentioned. Anne, why don't you have the last word as the lady on this panel?
Now, this is out of my wheelhouse, really. I do not have the expertise to really add anything that sounds halfway intelligent. So, but I do want to thank you, Patrick, for holding this program. I thought it was most interesting, and I really enjoyed speaking with my colleagues.
Anne, thank you so much. And look, this, ladies and gentlemen, has been our first panel session. I hope you've enjoyed it. Send us some likes, give us a thumbs up, give us feedback. We have a book of the week this week, which is Frank Partnoy's excellent study in procrastination. Wait, the useful art of procrastination. In other words, it's better to think before you necessarily do everything in a hyper low latency environment, which seems, well, actually quite salient advice, albeit perhaps not one which the Iranians should have listened to, because they seem to have outstayed their procrastination window during the course of the last week. It only remains for me, ladies and gentlemen, to say thank you very much to our panelists, Mark Beddis, Peter Randall, Ann Berg. If you would like to join the panel at some stage in the future, then ping us a message. If you've got a question for the panel in the future, if you've got someone you'd like to nominate, if somehow or other you'd like to be involved, or you'd just like to say what you think about this, give us some feedback. We'll be very, very happy to hear from you. We don't have an episode next week. Unfortunately, our guest has had to cancel under force majeure. So we're going to be back in probably a couple or 3 weeks' time. And the panel is going to return sometime during the course of July, I hope. And it'll be interesting to see who is on that for another wide-ranging and interesting discussion. I hope you've enjoyed the pith. I certainly have. I think this has been a fantastic episode from episode number 180 of the IPO-VID recording genre. I wish you all a great week in life and markets. Catch up with you for all the gossip in Exchange Invest about market structure. And finally, I just want to say a huge word of thanks to our terrific production team today. Thank you very much, Desiree. Thank you very much, Armenia. And thank you, Kim. And to our guests, Peter, Anne, and Mark, this was memorable. Have a great week in life and markets, everybody. Thank you very much.
Thanks.